This morning, Verve Group published a report for the third quarter here in 2024. And standing beside me here in the studio is CEO Remco Westermann. Welcome.
Mike, thank you for having me.
You've published your Q3 report today, and if you would summarize it briefly, how would such a summarize look like?
Yeah, we showed pretty good numbers, I think. We continue our path of growth. Actually, we're growing even faster than the quarters before. So we did 45% overall growth, revenue growth, 31% organic revenue growth. The difference is the June Group that we acquired in Q3. But 31% organic growth is really gaining market share in the market. So that's where we're super happy. The positioning that we chose is really working out. And the good thing is also, you see it also on the adjusted EBITDA, which was also 45% growth. So in that sense, it's not only top line, it's also bottom line. And meanwhile, we continue to invest in further growth to also make sure that we continue our growth path in the next quarters.
Indeed, revenue growth, 31% organically, whereas 45% is non-organically. If we look at the margins, non-adjusted it is lower from last year's Q3, from 81% to 32%. Also, EBIT decreased in that comparison. What are the main drivers behind the growth and the change in the margins?
Yeah, we had last year, there was a one-time effect in there because we had XIMMOTION and write-off of the earnout actually. So that made last year's numbers look a bit better. And this year we have the cost of the acquisition of June Group in. So that is also an adjustment that comes to the negative side. So you have a bit of negative, how to say it, if you adjust them, they are comparable. So if you look at adjusted EBITDA, you see an increase, an improvement by 1%, so going to 30% adjusted EBITDA. But if you keep the one-time effects in, then the EBIT and the EBITDA have, of course, a bit of different gearing. But overall, I can say the company is only getting stronger, only getting better, and getting more profitable. So those are basically bookkeeping things or have to do with one-time effects.
Very strong presence in the US, and we will get very deep into that. Before I do, I want to ask another thing that happened now, and it is that Paul Echt will step down as his role from CFO. Could you speak more on that?
Yeah, I'm sad about that. Paul is an exceptional CFO, and we have built this together in the last 7 years with the other team members, of course. But Paul has decided to step down, to go a bit slower. I mean, what we're doing here is high pace, a lot of work, a lot of traveling also. I'm in the US now every month, like a week or two. So it's a lot of pressure that you also get. Paul wanted to do it a bit more quiet, but we have found a great new CFO. It's Christian Duus. He's just stepped down as CFO at Adform. Adform is a Danish advertising company, a tech company, a bit more on the demand side. We're a bit stronger on the supply side, but also building demand side. So he knows the sector very well. He has worked with Bain & Co. Before, Bain & Company before, so also strong consulting background. So a great hire, we think, and I'm super happy and looking forward to work with him. But Paul will also not just leave, he will help Christian to onboard. So he has committed till end of June next year to be there and to support Christian.
And in the replacement question, Christian, then he's from Adform. Would you describe Adform as a competitor, or where are you recruiting from?
Yeah, there's many companies in this market, and we're all competing and we're all cooperating. So that's the interesting part. Adform is very strong in Europe. We're not so strong in Europe. Adform is very strong on the demand side, so working with the advertisers, which we certainly are not in Europe. So in that sense, we're not head-to-head competing. But we're even also doing some things together, and maybe we can even do a bit more in the future, based also on the relation that Christian, of course, has with the company.
So maybe pivoting a little bit towards Europe, or how should we sort of interpret that?
Yeah, you have seen that our US part has been growing. I think we came from 50% US revenues like 4 or 5 years ago to 80% US revenues now. Why? Or let's say, first of all, let me start to say I'm happy with a strong US position, because the US is the most competitive advertising market in the world. So if you can compete there, and we can, and you can grow your market share there, you can do it anywhere in the world. I think also versus our US competitors, we have a bit of an advantage that we know that Europe is not one Europe, but Europe is a combination of countries. And you need to go basically country by country. And a apart from, let's say, further continuing to grow strongly in the US and also hiring extra sellers and putting a lot of emphasis there, we have also said for next year we will double down more on some other territories. So we pick Scandinavia, Germany and UK from Europe, for example, where we say we will really expand our teams, get more supply, more local supply. We have a lot of global supply, but also make sure that we get to the advertisers. And in that sense, maybe also work more close with an Adform as also a potential customer for a lot of our supply.
Let's take a look then at your US position. 80% of your revenues were sourced from the market over there. Could you take a look in the rear view mirror towards the road that has led you to that? Could you speak on how the development has been?
Yeah, we started the whole AdTech or the advertising business with doing some acquisitions. Those companies, most of them had already position in the US. I think if you as a European company want to start in the US from scratch, it's super difficult to get a foot on the ground there. But having already bases, that helped us. Getting those companies together, integrating those companies made the bases even stronger. And then, let's say, having a European background and knowing what privacy is, because privacy rules here are more severe than they are in the US, gave us also a lot of extra tailwind, basically. Your story really is acceptable, is accepted by people. But there's other factors. US, if you look at customer onboarding, signing a contract in Europe takes, I don't know, a few months. In the US, it goes at least double as fast or faster. Test budget in Europe is maybe a 10K. In the US, it's a 50K. So you can also scale faster in the US. US is in that sense, fast to scale. And now we have, especially after the elections, but also already before, US, the market sentiment is much more positive. So people are really looking forward. Here, still in Europe, the attitude, the atmosphere is much more negative. So you see a lot of companies that are rather being careful with testing new things, with doing new things. And the US, it's full speed now.
Do you feel like your accomplishments in the US have overachieved your expectations?
Certainly, yes. Yes. We knew that, I mean, it's always difficult to really do a forecast. We forecast, or let's say we have in our guidance, 20 to 25% organic growth per year. And we have seen in end of 22, beginning 23, economy plays a big role. If the economy goes down, then also companies start cutting their marketing budgets because you can do it fast. They're coming back after a while. But so there's always a bit of, how to say, it's fluctuating. It's not a straight line that's there. But we are convinced that with all the investments that we've done in the contextual targeting, but also in direct supply, in having great salespeople out there, having great people that run the campaigns or optimize the campaigns, that we really have a setup now that is geared for strong growth also in the next years and quarters to come.
Could you elaborate a little bit on the competitive landscape in the US? It is by no means a small market.
No, US is huge, and interestingly enough, basically all the AdTech players come from the US. There's only very few in Europe. Adform is one of them. We have Criteo, which is based in France, but they are listed in the US. So if you look at the European landscape, there's not so much here. It's the Googles and all the kind of international guys that are working here. If you look at the player landscape in the US, then you have two, let's say, big outside of the walled gardens. I mean, the walled gardens is clear. That's a Google, that's an Amazon, that's a Facebook. They are all big advertising companies. Nevertheless, there's a very big world outside of those walled gardens. And there, the bigger players are, for example, Trade Desk, AppLovin, which is growing very fast. Similar to us, also focusing very much on in-app. So you see that apps now is, or let's say in-app traffic, mobile traffic is growing fast. But also Magnite, PubMatic. So there's more companies there, most of them listed, or a lot of them listed. But there's also companies like InMobi, for example, that's not listed. So we have a lot of peers there. Those are the bigger ones. But if you look at the total landscape, there's, in my view, too many. We talk about over 100 supply-side platforms, over 100 demand-side platforms, and nobody needs that. Over 200 data platforms, data providers. That's too many. And so what we see now is really consolidation. Smaller players don't have the money to invest. Not so profitable players have an issue. So we see people dropping out of the market. There's a bit of consolidation going on in the market, so also companies buying each other. So the landscape will change, and yeah, we expect, I don't know, in 5 to 10 years that there will be 10 to 15 big advertising companies, and that there might be some specialists, but that this landscape will look totally different than now.
But in your growth, could you elaborate a little bit on what you see there? Is it that you're growing with the growing market, the hyper trend that is AI, and of course its connection to advertising, or would you say that you're taking market shares from others?
Yeah, we're clearly gaining market share. We have made our lives a bit easier to pick emerging channels, emerging markets. So mobile is growing like 12% per year on average. Connected TV is also growing at a similar speed. So if we don't grow at least with, let's say, a 10, 12%, we do something wrong, because then we are not gaining market share. But growing faster, and with 31% organic, because we need to take the organic growth here, I think, for fairness reasons. We are able to grow much faster than the market. Why are we doing that? I think that's what you're pointing at. The main things is the market is disrupting, first of all, being disrupted. Identify is going away. More and more traffic, or more ads that are being served. You don't have a cookie, you don't have IDFA from Apple. And an advertiser hates one thing, and that's just blindly sending out advertising money, because that's totally inefficient. And if now let's say the part where you have a cookie gets smaller, and everybody's bidding there, the prices go up. So that makes your advertising also not more efficient. So the big challenge for the whole sector is, what do I do with the part where there's no identifier, where there's no cookie? And if I'm able to target there, in the land of the blind kind of, then you have a double effect. You have less competition that's targeting there, and you have lower CPMs, lower prices for the ads. And that's what we saw coming. Let's say when we started into advertising, we said, okay, this is the big disruption. It's it's a big risk factor for the whole market, but it's an opportunity for the one that solves it. And as a result, we have been investing a lot in ID-less targeting. We have products like Moments AI, where we crawl the internet and make combinations and see where is an environment to target. 75% of the content that people are looking on at a certain day is less than 24 hours old, so you need to continuously see what kind of content is there, because you want to have your ad in a kind of content category where it makes sense. And then the other thing that we developed, for example, is Atom, anonymous targeting on mobile device, where with our let's say software that we have installed in the apps to serve the ads, we also include a piece of software that is collecting data on the device. Those data are not leaving the device, but we build categories out of it. So that means we can see on the device if somebody's walking a lot, or if somebody's going a lot outdoor, if somebody's going to nature parks, for example. Then we can build a category like a nature lover. If now there's an advertiser that wants to advertise tents or walking shoes or something like that, he knows that that's a person to target. And so that's what we're doing, but we have several different ways. It's a lot of AI actually that we use there. And to give an example, a weather site, a weather page, you can advertise a lot of stuff on, but also there you can waste a lot of ads. And but with our AI, we can at a certain point, let's say, find out that if you advertise between 9 and 10 in the morning, you get a lot of young women that have young kids and that want to go out with the kid and want to see how the weather is going to develop. And that's an ideal slot, for example, then to advertise diapers. So that's a very stupid example, but those kind of things we do. So we see if there's no cookie, you cannot build a profile, so you need to do different ways. You need to go into different ways. And that's what we are putting a lot of innovation power in, and get them patented also, luckily. So that's a nice thing to work on.
So correct me if I'm wrong here, it was a lot to bite into when it comes to the ID-less advertising, but it's instead of sourcing the data from the cookies as you described it, it's instead sourcing it from the other side, from the web page, for instance, or how does it look like? Yeah,
it's coming more from the user side. So the closer you are to the user actually, that's where the data are. And traditionally, let's say if you have a cookie, you build a profile, so you see if there's an ad coming from somewhere, there's a cookie connected to it, then I look up in the table, oh, this cookie belongs to this cookie, and it belongs to this mobile ID, and it belongs to this IP address, for example. And then you have collected a number of factors. It's a male, living in a big city, driving a fast car, something like that. So you know that you really can then target that to or let's say look for the right advertiser for that. If you don't have this cookie, you don't have all these things. And then you can either look, of course, what's the page content, If there's a car magazine with a mobile car, let's say outlet, a mobile page or mobile app, yeah, you can advertise cars there. But is that the most efficient? If I'm a luxury car manufacturer, I want to target people that are interested in cars, but I also want to target people that I can afford the car. So I need to look at certain, let's say, city areas maybe where people have a higher income category. So you have a lot of data that you have, and the more data, the more you can target. But it's different than doing it with a cookie, and I think that's where the world is now going towards. We see that a lot of companies have not invested into it. We did it in early stage, and that's now paying off.
And in what sort of form is that paying off? Are you already seeing interest from potential customers? Are dialogues being carried out? I'll give you some leeway here to answer it as you wish.
Yeah, no, we have, I think the best thing to see is gaining market share. I mean, gaining market share has to do with doing things that are different than others, showing, getting better results. We only get paid if an ad is really being served. So we are basically an auction platform, and only a winning ad, there's a revenue stream, and only if there's a revenue stream you can make money with it. So that's for us important. So we need to prove that we're better, because only if an advertiser increases his budget, we will make more money. But also with onboarding new customers, we can show, let's say we can tell a great story, of course, but we have also a lot of test data from the market now, or where we can prove that what we're doing is really working very well. That's showing better targeting. So we get a lot of new customers. If you see our new customer number, over 50% growth of new large customers. The customers do more than $100,000 per year. So there you see a strong growth. And also, let's say, if you look, and that's a number that we didn't publish now in this quarter, but also in the overall customers that are onboarding, we see a strong growth. And that's, of course, the driver of future revenues.
Early on the ball then, when it comes to the USP you've spoken about, the ID-less advertising, but seeing how 80% of your revenue is sourced from the US currently, what sort of more reassurances do you have that your market share is sustainable long term?
The US market is huge. We're talking about advertising is $1,000 billion per year that are spent there. Per US citizen, there's over $1,000 per head being spent. It's 50% roughly of the total overall market. 60% of that market is digital. So there's a lot of growth potential that we still have to go. I mean, we are still a very small player in this market. So growth is, I would not say indefinite, but there's a lot of potential there.
And how important is June, the acquisition that you made this year, into that puzzle, please?
Yeah, June is very helpful. We are positioned between advertiser and publisher. So we want to work directly with an advertiser and directly with a publisher. With the advertiser, it's often also their agency, because they are basically delegating the work to the agency or doing it closely together with them. From start and by the acquisitions we did, we have a very strong position on the supply side. So we're integrated in over 65,000 apps. We have a direct household reach with CTV of 60% of the market. So that's a very strong position from the supply side. Part of that is sold via third-party DSPs, demand-side platforms like a Trade Desk and like others. What you really want is to really sit together with the advertiser and see that how can you best help them to spend their budget. So the more we get direct advertising going on direct supply, the more efficient the whole thing gets. Building up your own advertiser side, your demand side, takes time because it has a lot to do with relation, also the story, of course, that helps. We were doing that, but June Group has already a lot of those agency relations. So it was an acquisition that really brings us a lot of extra demand side contacts in there, which makes the whole thing more efficient. And that's what you also see in our EBITDA and EBIT, guidance for the next years. We have taken up our guidance because we expect just also to make more EBITDA because of working for both sides. And on top of that, we are also able to give a bit more margin also to both sides. So if the whole thing gets more efficient, you can take a bit more yourself, but you can also give more to the others.
A question from the chat in regards to June asks the following question. Do you expect to be able to sustain a double-digit growth for June?
June is working in the same segment, so if we wouldn't do double-digit growth, we do something totally wrong. So yes, and we are now working on June integration. So the acquisition was closed by 31st of July. So it's also consolidated now for 2 months into the numbers of Q3. It will be fully consolidated in Q4. what we do when we buy a company, it's not like here comes the conqueror and we just swallow everything. So you need to do that in a tactical way. So we sit together with the team, we see what makes most sense. There is an integration plan now, which we have been working on. We see that the first synergies are starting to kick in. They are selling quite a bit of CTV, connected TV, to their agencies and advertisers. And that was CTV they were sourcing somewhere else. Now they get it from us, so that means they can offer it cheaper to the advertiser. They have much more control on the quality. There's no middleman between it, all these kind of things. And there we see the first synergies, so that's already starting to work. But we also work on technical connections with their platforms and things, and that will all kick in from early next year. So we'll gradually see more synergies coming up, but it will grow also during next year.
Do you expect to acquire anything else in 2025, or what's the current plan?
A very good question. Very, let's say it's one that we're getting more of now. We have, let's say, built the critical mass or the basis of what we do with M&A. Because as I said before, if you start from scratch with this, especially in the US, you have no chance. With the critical mass, however, we have built a very strong organic growth machine. Which we're showing. I mean, over 30% organic is really, I would say, pretty strong. And if you do M&A, you disturb a bit of that, because if you do M&A, you need to integrate, and people are distracted. You need to integrate platforms, you need to integrate teams, all those kind of things. So our main focus is really on driving organic growth. If then, however, something comes, passes, or something is offered to us, where we really say there's a lot of synergy in there, so it's very accretive. Where we also see that the team fits, because that's very important. We have a great team spirit. I would not like to destroy that with doing an acquisition with a team that doesn't harmonize with what we have. And then also the price is right, so that you don't pay too much for it. Then we make exceptions. I think that's the way to it. So we do organic, and we make an exception sometimes for M&A. June was the first one in 7 quarters actually that we did. But there is, as I said before, there's consolidation going on in the market. So there might be an opportunity, but we mostly want to say no to acquisition targets, because I don't want to damage our organic growth.
Organic first then?
Organic first, yeah, absolutely.
Something super special comes along, and if you could dream, could you speak more on that super special? What would that look like?
What can be super special? I mean, again, getting more to the demand side, like a June Group. June Group is a super example of that. There's also on the supply side, we don't have so much direct supply yet on digital out of home, for example. So it could be a player who has already the supply. So it's about critical mass. It's about also maybe technology solutions. There might be something really cool that a small startup has done that is almost more an acqui-hire. So those are things that might make sense. But as said, it has to be super special for us to do it.
In terms of dividing your revenues in geographically, US 80%, for instance, how do you view that figure sort of moving when you move forward now into 2025?
Also, good question, and a question that I had also a few times now. Difficult to say. We have been strongly focusing on the US because that's where we grow fastest, and a lot of reasons to grow faster. We are a global company, and the more volume we run on the platform, it's a global platform, the more efficient we get, and the better we get. We need to go a country by country strategy outside, or basically everywhere. US is also a country, but a big one. And we are not going to stop growth somewhere. So it's not now that we say, okay, we want to increase our share of market in Europe, and therefore we are going to slow down in the US. So in that sense, it's difficult to say. I mean, US so far has been growing the fastest. We're investing now. We will certainly invest also more in other countries. But seeing the profile of US and still how big the market is, I would assume that US still will remain to be a very big part of our business.
Can you elaborate on what sort of segments that you see will drive growth moving forward then?
Yeah, it's different segments, different trends also. The biggest segment that we are now working for is basically food and retail, which is almost 50% of our demand side, so basically of the advertiser side. That's a big segment. There you have also 2 different categories. You have, or let's say 2 ways of targeting. You have performance targeting, which means I want to have an app install, or I want to sell goods, things like that. And you have brand advertising. We focus on both, so that's, and almost every customer wants to have both. But also there you see things at the time that companies are more under pressure. They go more for performance advertising, which is sometimes stupid because the brand is equally important to build that. So you need to do both. We can do both, and yeah, we're basically also growing on that.
And if I turn towards the questions asked by some viewers, I want to first, in regards to your listing, there has been a lot of question marks. You're currently in the First North list here in Sweden, one of the highest or the largest companies measured on market cap, giving cause to sort of speculate whether or not a list change is in the works. And of course, there's the main Stockholm stock market list, but there's also the US list, which are current presence there. Is there any plans to either also list yourself on the US market or to leave the Stockholm market?
Yeah, your observation is absolutely correct. I mean, most of our peers are listed in the US. Most of our peers are based in the US. That means they have much higher personnel costs than we do, because if you have only personnel in the US, it's much more expensive from a salary point of view. They pay much higher stock packages, all those kind of things. So there's differences between the companies. Our biggest stock market, because we're also listed in Germany, our biggest stock market now is Sweden. We have what is almost 3/4 of our trading is here. It's a lot of retail investors that are individual investors that are in our stock. We have seen after the market went down here that a lot of institutional investors are a little bit on the sideline and not yet are coming in. We would expect them at a certain point also to come in again. Germany also is really interested in what we're doing. It makes sense to talk to US investors, which we also do. Would we do a listing there? Maybe at a certain point. But building a European hero, and we are a European company. We're domiciled here in Sweden. That's basically what would make me proud. But it has a lot to do with the investors. I mean, if you get an investor base, you can get valuations like in the US, also in Europe. If you're able to do that, there's no reason to go to the US. On the other hand, maybe we can do multiple listings. There's nothing decided on that, but it's something that we, of course, also internally discussing what makes sense. But no fear, we're not going to leave Sweden. And actually, our new CFO, Christian, he's Danish, he speaks fluent Swedish. He lives in Stockholm, actually. So in that sense, I think we are even stronger involved here.
In the presentation today, you mentioned direct ad supply. Could you elaborate on what that is and why it's so important for Word?
Yeah, direct ad supply is really being directly integrating with the publisher. So not buying, let's say, ad volume via somebody else, via another platform, but really being directly integrated, like in an app or on a mobile page, or let's say having direct integration with the CTV, the connected TV station, so that you really are, basically have a billing relation, a technical relation, and a people relation with the publisher.
Mm-hmm. More questions from the chat then, and this is regards to, I think, your competitive landscape. How does your strategy change now that Google have repeated several times that they will remain having third-party cookies?
That's not so clearly said. Let's say Google, maybe a bit of history there. Google wanted to deprecate the cookie. They had Privacy Sandbox as a solution for that. And Privacy Sandbox also included that basically if you wanted to use the whole solution of it, that you also had to use the ad server of Google. That's what the regulators didn't like so much. So that's the reason that the UK regulator, and I think also the US regulator in the end said, okay, this is not going to work, we're not going to accept it. So Google had to withdraw the deprecation of cookies. But already with the messaging then, they said, yes, but we're going to listen to the consumer. And if you listen to the consumer, 80% is going to say, I don't want my data to be shared. So we are moving into an environment without cookies anyway. Google is still working on Privacy Sandbox. They might call it differently now. They might not include their ad server anymore, but they are going into that direction. If you see what Apple, by doing it, has gained from it, and Apple is now building up its own advertising business also, that's something that Google is also learning from. On the other hand, there might be other things happening with Google, because the Department of Justice has, let's say, several processes with Google, against Google, how you say. And there's a lot of talk about breaking up Google, that the advertising platform might go out. Because now if you see the advertising platform together with YouTube and then with their search, is an extremely strong combination. So there might also be, let's say, a lot of changes in the market again, if it's disconnected, it would, let's say, make a very strong player a lot weaker.
And are you ready then on the sidelines if that were to occur to sort of grab market shares?
We are always ready to grab market share, yes. Yeah, but it's difficult to forecast. Also now with the new government in the US, it's not clear what's exactly going to happen. But whatever happens in the market, we're of course on top of it and will use every opportunity that's there.
Do you have any sort of image or plan to how your buybacks of bonds will look like during 2025?
Yeah, we have announced that we think that our interest payments are a bit on the high side. So we're paying over 40 million of euros of interest on an annual basis. That has to do with our high yield bonds. We have two bonds, one that's maturing in 27 and the other one in 26. And we have announced already during the presentation also that we are looking at doing a refinancing, which we can do in, let's say, starting to do in somewhere in there, let's say, the buyback starts somewhere in early March. So we can do that, and seeing now also that the bonds are trading at 105, 106, we will be able to refinance with lower interest costs. And also Euribor, we expect to further go down. So we indeed assume that we will pay less interest next year. How the refinance will look, if that's a bank financing or bond or things, that's still not decided.
Last questions then from the viewers. Long term, are you aiming to get down your leverage ratio lower than between 1.5 and 2.5 in the future?
The plan that we have communicated now indeed is to be between 1.5 and 2.5. We are now at end of Q3 at 2.6. So by the end of the year, we will clearly be under 2.5. We expect next year to be able to go to 2. And then the question, of course, is how far do you want to delever? If you would do an acquisition, you can always have a little bit going up. Organically, there's a natural tendency that it goes down. Has to do with how much do you invest in growth. So at the moment, I would like to keep it with the guidance 1.5 to 2.5. And a bit of leverage is, I think, also good for equity holders because it just is the yield on equity is better. And we also have happy bondholders at the moment. So I think we try to make everybody's life happy.
Then Remco, I will end this interview by asking you to look forward into 2025 and perhaps even 2026. What are some highlights and what are some things that you really look forward to during next year?
Yeah, I'm looking forward to 2025 and also the years after because we have built such a strong combination now with our positioning, with the possibility to further scale on it, that yeah, it's not a walk in the park. I mean, it's never as if you run a company, but the company is better positioned than ever, and we are going to really benefit from everything that we've built. So I'm really looking forward to the next quarters to come and growing the company further.
Remco Westermann, CEO of Verve Group, thank you very much for being here and answering our questions.
Thank you, Mike. Thank you very much.